And welcome back, everyone, to WealthWise with me, your host, Jordan Kimmel. And you know José Torres from all the shows. He's on more than most. José, first of all, thanks a ton for joining us.
Absolutely, Jordan. Great to be here. Great to see you. Thank you.
Yeah, so look, there's a lot to go after today. Um, and let me just start by saying this, that we'll talk about today, what's going on today, of course, but the presidential election seems to be taking on more importance this time than I think any time in my life in terms of policies. So we could talk about whether we think the economy is expanding or contracting, but let's talk really about the election itself and how you see the differences and how you might play it with real money.
Sure. So, quite simply, if Trump wins, I'm liking more of the cyclical, domestically oriented names. So, broadly speaking, the Dow Jones Industrial Average and the S&P 500. Sorry, the Dow Jones Industrial Average and the Russell 2000, where on the
Okay.
Harris side, broadly, S&P 500 and the Qs. Harris is from Silicon Valley. She favors a more globalist kind of approach. So I'm thinking she's going to be more favorable to tech stocks, where Trump is probably going to be more favorable to regional banks, industrials, energy companies, etc. I think, unfortunately, for the budget deficit, both sides are going to be inflationary, right? Trump is not a budget hawk by any means. Probably more of a more of a hawk on the budget side than Harris, probably. But one important ingredient, Jordan, is shelter inflation. Shelter inflation has been a consequence of Washington's irresponsibility for a long time, pretty much since the 2008 global financial crisis. It's been that hidden cost of living burden that's just gotten worse and worse since 2008. And one of the main shifts that got that sort of opened up the path to that trend was the Fed shifting away from the consumer price index to the PCE price index as their main gauge. The latter indicator actually accounts for housing way less than the CPI. Call it 45% on the CPI, 26% on PCE. Rough numbers off the top of my head. So I think with the Harris administration, she is an immigration dove. The Democratic Party
Okay.
recently has been open to immigration, right?
No
Those immigrants,
doubt.
yeah, those immigrants, a lot of them, they're coming for better economic opportunities. So a lot of them, they're looking for jobs, they're working, they're renting places, driving, rental absorption rates higher, driving cap rates lower, apartment building prices higher. Eventually, that permeates to the residential real estate, to single family as well. A lot of those folks also end up buying homes as well. So I think Harris is going to be an inflationary president. I think from the growth side now, President Trump is going to be better from the growth side, because I think that in his first administration, we saw a lot of pro-growth kind of policies, right? Lighter taxes without that much of a hit to revenue, right? Deregulatory agenda that loosens up restrictions, particularly for small and medium-sized businesses. Jordan, COVID-19 absolutely destroyed small businesses, made it so hard for them to
Yeah.
survive. Who benefited? Big tech did great. Everyone was on their telephones at home, navigating the internet, using the social media, all that kind of stuff. Look at the Russell 2000. We haven't made a new high on the Russell 2000, right? Because
It's been a while, right?
we've had this very narrow rally. So I think with Trump, I think those segments of the economy are starting to or will begin to get some love again. I think generally speaking, if you look at what's going on in small business today, sort of in a recession. We have a lot of bankruptcies in small business. Those folks have a lot of difficulty hiring right candidates at a decent cost, because a lot of the large corporates have much more pricing power when it comes to hiring employees and giving them high wages and benefits, right? So small businesses have really been sort of hung out to dry, and I'm expecting that segment to do a lot better under a Trump victory.
Right. And you know what, Jose, I think you covered a lot of different bases and I love that. And you know what I think about a lot is the way the economy changes so dynamically. And years ago I read books about this and future shock, and they talked about the acceleration of change. But what we're seeing right now is the economy has changed so much. Like we're hanging on the cliff for like the non-farms payroll number. And I'm going, guys, who's working at the farm? What do you mean non-farm payroll? Catch up a little bit. And the thing is, we know where the growth comes from smaller businesses. And you know what? I'm thinking maybe another change, Jose, maybe in the economic fabric is we go from these mega corporations to smaller corporations to now 5 and 10 and 20 people. And they don't really show up, I don't think, in any economic numbers, to track who's working, who's starting LLCs. And it's an economy where people say, I'd rather not work for somebody else. Let me try to do this myself. And you see tremendous amount of websites popping up with people starting their own businesses. Is there any way from your perch, you have a handle on that side of the economy?
Absolutely. I think ultimately starting small businesses has become incredibly difficult for folks of all walks of life, particularly the younger generations. Another dynamic, becoming a landlord is no longer profitable
Right.
the way it used to be back 10, 15 years ago, when a lot of the small guys, all they had to do was save their first $20,000 or $30,000. Bam, that's a down payment. They're in. Now they're a landlord. Now they can operate well, start adding properties, right? But mortgage rates and cap rates and the distortions from the pandemic made it where only the really big players can get into residential real estate and make money in the medium to long term, right? The short term, the smaller guys are really having trouble because they just can't get in. They need to pay all cash and stuff, which was really back then no one really did. It was really a 20% down and then you rent kind of situation. As far as small businesses, yeah, I mean, I think the government does a decent job at calculating what goes on in small businesses. I did spend 3 years at Bureau of Labor Statistics. One of my main roles was maximizing response. About half of the surveyed respondents or the businesses that the Bureau talks to are smaller businesses. But one area that I like to go to a lot is ADP employment, because they actually break down the hiring across small, mid, and large, and small has been notably weaker. Also, National Federation of Independent Business tells you a lot about what small businesses are feeling. The only thing is that small business owners tend to be much more Republican. So those surveys do have a political tilt.
Right.
Um, but small businesses have been suffering with inflation. They've been suffering with cost of labor, quality of labor, cost of financing. Final point here, Jordan, before we move on. Those smaller businesses, they can't just go to Wall Street and refinance. They don't have access to the best capital terms and financing structures, right? They really have to, a lot of times they go to their regional banks to secure financing, because a lot of the larger
Right.
banks, they don't do that. They don't do, liberal kind of small business lending.
Well, let me make a little idea prediction that I think might happen, and it probably will happen if Trump gets elected. Remember when we had the housing crisis and the global meltdown and the government stepped in and became actually a mortgage bank, and they took Freddie Mae, and they started actually becoming very super profitable because, Jose, people do pay their mortgages, and it's great to be in the mortgage business. Watch for a government sponsored, not so much of a bailout, but an opportunity for residential, commercial real estate to begin refinancing through the government. And the government will be very happy to do this at 3-4%. And all of a sudden a lot of the commercial real estate will find itself worked out through a plan where the government will actually make money. And we've seen John Paulson in the media a lot lately, the next Secretary of Treasury, I believe. So let's not talk about something else here. We had this inverted yield curve, and this thing was like hanging over everyone's head because every time there's an inverted yield curve, we know what goes on next. Well, all of a sudden the yield curve uninverted now. And history's not kind after the uninversion. People say, now that they start to lower rates, we're homemade, and we could basically it's risk on, baby. And talk about the history of when the yield curve uninverted and some unintended consequences showed up.
Yeah, sure. I mean, usually, like you said, usually when that spread narrows and becomes positive, usually 50 basis points is what's required for sort of a risk-off move in markets. Right now, we're at around 20 basis points, so we still got to move. And the idea is that the reason that short-term rates plunge so fast is because the Fed is late, and historically, the Fed has been late. But these days, Jordan, we have central banks that are really in tune with what's going on with financial markets, what's going on with stock prices. They're allergic to volatility. They want to calm the market all the time.
Right.
And unfortunately, Jordan, America didn't become the greatest economy in the world by quelling volatility and calming markets all the time. We've had downturns. We've had volatility. We've had washouts. Those washouts aren't terrible. Yes, values go down, but in aggregate, what happens? Those good businesses with strong managers, people that are invested in the business, invested in society, those businesses tend to do well. The businesses that get washed out are the ones that were maybe run irresponsibly, maybe too much risk, not a good business plan, lackadaisical, complacent, all those traits, right? And for so long, we've wanted to, for whatever reason, become like Europe. Oh, they regulate more. Look how happy they are over there. Look at the immigration, right? And that's what we're doing. We're becoming a centrally planned economy, right? And now with Chair Powell, last week issuing that 50, giving a signal to the market, don't worry, we will not tolerate any labor market cooling, right? But what about inflation? What about price pressures, right? You just going to throw that out the window and just, why not leave some dry powder on the table in case inflationary pressures flare back up? You can come in, and you can cut from a higher level. But instead, central banks just really wanted to dish out the liquidity. In fact, you saw China this morning. They came out with a really aggressive stimulus plan. Their stocks are up 4%. Right? It seems like that's really the direction that central banks are going.
Well, you know what? I think that everything you said is correct up until maybe with a new administration, there'll be a little bit less big government central planning, a little bit more free market, and we'll grow out of the deficit. Um, Let me just, go to this other point where, what people look at the bond market, and again, I look and I got turned off from the bond market early in my career when I realized that inflation will always destroy a bond portfolio, regardless of what they report inflation. So I look at the bond market more for like the tell of whether the market is healthy or not. So the thing is, we talked about the yield curve, but there's also something called credit spreads and what you're willing to pay for riskier bonds or less risky bonds. So when the spreads are increasing, uh, you might not see it in the stock market today, but you feel a big volatility coming. And when the spreads narrow, we could be kind of mindful of valuation and be prudent investors. But narrowing spreads means what? The stock market is in risk on mode, right? And so tell the audience right now the credit spreads where we are, and more importantly, where we are they spreading or are they narrowing?
Yeah, so they're definitely narrowing, indicating complacent conditions, right? And for good reason. If the Fed is going to tell you that, the Fed put is back, ladies and gentlemen. If the Fed's going to tell you, hey, any problems, we're right here, then sure, folks are going to go into the high yield aspects of the market and, bid up those prices, bring those yields down closer to, more theoretically risk-free investments like treasuries, and then those spreads will narrow. They also, really good point, they correlate very well with the volatility index, the VIX, right? Typically when
Makes
credit
sense.
spreads, yeah, when the credit spreads are lower, the VIX is lower. I'm going to pull it up real quick on my computer just to give us
Sure.
some historical reference. But yeah, I mean, credit spreads rose right around September 10th. In the beginning of the month, we thought September, some bad seasonals. Remember that bad CPI report we got?
Oh,
The S&P
yeah.
traded down to 5,400. Of course, yen carry trade, high yield spreads were roughly 80 bips higher than they are now. Early September, they were 40 bips higher than they are now. So yeah,
Interesting.
we've made some work on high yield credit spreads. In fact, we're only 10 bips higher than the lowest point we've been all year, which was on March 21st.
Okay, that's really important to know. So let me actually ask a kind of, I don't know whether it's a political question, but it's something that really interests me. So if you took an individual or an entity or foundation that had long-term obligations and always left their money in the money market or, earning 0%, you're going to actually have some problems down the road. What I'm getting at is Norway set up, they were one of the first to set up a sovereign fund, a sovereign wealth fund. And they said, we're going to run out of oil. We want to diversify ourselves. That country has become immensely wealthy, not only from their oil, but through their sovereign fund. And my question is, the United States of America has a treasury size, something, it's always left earnings zero and inflation and costs are chipping away at it. If an individual always left their money in the money market, their cost of, the capital would shrivel up, and we've seen that over time. Do you think it makes any sense for a portion of the US wealth to be in a sovereign fund, or is that just kind of putting more gas on the stock market?
I mean, so is the question, should we set up a sovereign wealth fund here kind
Yeah,
of thing?
why didn't we? Why didn't we when all these other countries have? And lots
I
of
mean,
other countries have.
off the top of my head, I am going to say that a lot of them have done it because they have a lack of publicly traded companies in their own nation, within their own borders. Like, who does Norway have? That's a big that's a
Just a
big,
couple. Just a
just
couple.
maybe a couple. And if you're big into European stocks, that's not an insult. It's just here from stateside, we realize that a lot of those like famous sovereign wealth funds, like in Saudi Arabia or Norway, they maybe have a lack of domestic companies to invest in, so they go out. In terms of money markets, Jordan, I'm going to push back a little bit because real rates have been positive now. So I know they were paying zero for a while, but today they're still paying in the mid threes. But you're right, with inflation at 2.5, getting paid mid threes on money markets, it's not really that great, right?
Right.
Um,
Well, when you see inflation's 2.5, the thing is they always underreport. And you know what? I'm going to just go to, one of my favorite indicators is, and again, there's a distribution of outcome with people. There's just more people, some really wealthy, most aren't, right? That's the case. But will the cost of a Super Bowl ticket or the NCAA basketball finals, are those tickets going lower or are they going higher? And the answer is we know what they're doing. They're going higher. And so I believe we're in there's only one time in the country's history where we really saw deflation, right? And that's the scariest part for a country, to be in a deflationary period. So while all the presidential, we were going to bring in costs down, they'd like to actually have costs go up by less and less, because maybe just talk for a minute about what deflation means and how that actually is, I think, scarier to administrations than inflation, frankly.
Sure. So deflation means negative prices going down. We saw that during the Great Depression. That was an important lesson for all central banks around the world. And the idea is that once prices start going down, it really starts to distort signals in the market and really destroys demand and weakens the economy. Against that backdrop, the reason you want prices to increase slightly is because
Right.
you do have bursts not as much as you had in the past, right? That's more of a demographic problem. But in this country, we don't really need births because we have immigration, right? So to the extent that our population is growing, then the pool of money should expand at least a little bit to accommodate rising productivity as well as rising population, right? So when you have rising productivity and a rising population, then you have deflation, right? That implies that the pie of money is shrinking. So it really points to scarcity on cash out there, and really creates asset values start to go down. People start to wait, Jordan, because
Exactly. They think they can buy something cheaper. They think they can buy something cheaper and they wait.
Those tickets, I'm waiting, Jordan. You said they were higher, but I'm waiting.
Well, it goes on every year. So look, I think the point is really important here that, we're in this place right now where I think there's so much money facing almost everything that I think Goldilocks has showed up. And Goldilocks doesn't hang around Wall Street for a long time. When Goldilocks shows up, people are happy and complacent. But, I think before we got on the show and we just talked for just a minute, there's a lot of people, Jose, right now that value has been displaced from price, and any kind of value investing approach has been really just run over by momentum approach, and these things do change and they have a reversion to the mean. So I think that the only thing that we can do is we can predict a little bit. We could see far out, but the most important thing is we have someone like Jose, we have someone like people who like to look at what's going on right now, what's the real trend, and kind of honest up to what's really going on. And then we could set a path from there. What do you think of that?
Yeah, I think that's important. And personally, a little startled because I've been a value investor for so long. Personally, it's been a style that I like. Price to book, price to cash flow, price to earnings. If I invest in a company, theoretically, how long does it take for me to get my money back? Those were the principles that literally built my career as an investor and as an economist. So, the last few years, central banks have just really flooded the markets with liquidity and has made it extremely hard for capital allocators like myself, and not just me, but hedge funds. A lot of hedge funds have trouble outperforming. Folks all over the street are laughing. They're saying, oh yeah, well, I'm going to invest my money in this automatic ETF because you guys are going to work 100 hours a week, but this automatic ETF is going to make more money than you guys. You guys are going to be doing all kinds of complex strategies with options and futures and long short and all that stuff, and this automatic app is gonna do better, right? So it's been a very, very difficult investing landscape overall. Look at Chinese stocks, for example, right? We thought that the China market was doing poorly. Oil prices were really weak. Then this morning, China comes out with a huge stimulus package. Bam, China stocks are up 5%. All other equity markets are kind of joining the party. We're seeing
fight the Fed, whether they're English, American, or Chinese. So it's a wide range discussion. Here's what we know we normally don't know anything in the market for sure. What we can pretty much guess or think we know, rates are going to come down on the short end. It's how people react to that, and whether or not we can just stay in this Goldilocks environment. But to wrap things up, what I want to just share, Jose, is that what I think, there's two things: what you think should happen, and then you have to look at the box score, and the box score tells you what is happening. And if you're out of sync with the market, and your expectations aren't being met, then maybe you trade a little lower. You take the stress down, and that the cycle will come back. But don't fight the market, don't fight the Fed, don't fight your emotions, don't fight anything. That's my belief in investing. Is what works. Sometimes you have to just duck,
Yeah,
so
absolutely.
so
One thing,
Jose, we love having you on. Show both hands, because I call you the one-handed economist. You tell it like it is, even though you have two hands. I wanted to prove to everyone that you do. I think you're one of the best on the street, and we thank you for your time today.
thank you, Jordan. Looking forward to come back soon.
All righty. Well, we need to wrap up. It's Jordan Kimmel wrapping up another Great episode with WealthWise, José Torres, Senior Economist, Interactive Broker. We'll see you soon. Bye now.